Frontline indices have tumbled around 5% each since October 2021 after hawkish global central banks, especially the US Federal Reserve, spooked investors out of their easy money bubble. The Russia-Ukraine war also added fuel to the fire as it elevated prices of key commodities, especially Brent crude, to a 14-year high. However, a wave of gloom spilled across Asian markets last Friday, with India as no exception, as the US Fed hinted at 50 BPS rate hike in May, while analysts assert that the markets are already pricing in the rate hike, the quantum of hike, and the pace can trigger a knee-jerk reaction. Market analyst U.R. Bhatt, for instance, expects that the markets will eventually price in the rate hike and later recover the lost ground.
The pace of tightening is only potential surprise. Otherwise, that they will tighten, and that they will probably do it at 25 basis points each time is a given. Now, whatever, 8 or 9 times during the next 12 months. But I think if they do with accelerated accelerated hike, like say 50 basis points, that could probably be a potential surprise, and that could probably affect sentiment. But I don't think they're increasing by 25 basis points is really going to affect sentiment too much, because it's all well known and already factored in. When actually 50 basis point happens, I think there would be some sort of a reaction in the market. But that will also get absorbed, because it's just a matter of pace now. That it will go up by whatever 8 or 10 times, which is about more than 2%. That is a given.
Okay.
So if they do it very fast at 50 basis point each 4 times instead of 25 basis point 8 times, then that I think might affect sentiment a bit. The number is well known, that they would do it over 8 times or 10 times or something like that. So 2 to 2.5% hike is a given within the next 18 months or something like that. Now the pace is the only surprise that can be.
VK Vijay Kumar of Geojit Financial Services too believes the Fed's half-point hike may temporarily steer markets in negative territory. The comment by Fed Chief Jerome Powell that a 50 BPS rate hike is possible in May and the need to control inflation has pushed the 10-year bond yield above 2.9%, says Vijay Kumar. While the market has already discounted this hawkishness of the US Fed, investors should buy high-quality stocks on steep corrections and wait with patience in this time of uncertainty, he suggests. However, global brokerage Nomura is of the view that the US Central Bank will aggressively raise rates by 75 BPS combined in its June and July meetings. It also believes that though markets have been reluctant to price 75 BPS hike, a stronger pricing for such a move would ease the path for the FOMC. Moreover, following the 275 BPS hikes in June and July, Nomura expects the US Fed to hike rates by 25 BPS at every meeting scheduled in 2022 and 2023. They expect 300 BPS of cumulative tightening this year, up from their previous forecast of 250 BPS. Against this backdrop, global cues, bond yield movement, and macroeconomic developments will guide the markets this week. Back home, investors will react to private lender ICICI Bank's Q4 results in trade today. Later in the week, 9 Nifty companies are expected to report their Q4 scorecard, including Bajaj Twins, HDFC Life, Bajaj Auto, HUL, Axis Bank, Maruti Suzuki, Ultratech Cement, and Wipro.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.